All right, let's get right to it. The new IRS standard mileage rate for business use in 2026 is 72.5 cents per mile. Yep, that's a 2.5 cent increase from 2025. So let's unpack what this number really means for your bottom line. Now, 72.5 cents per mile is the number everyone talks about, but it's really just one piece of the puzzle. The IRS actually gives us 4 different mileage rates for 2026. Each rate has a totally different purpose and a different number attached to it. So here's the full breakdown. The business rate is now 72.5 cents per mile. That rate is based on an annual study that looks at both fixed costs, like insurance and depreciation, and variable costs, like gas and maintenance. The medical and moving rates are 20.5 cents per mile. Those rates drop slightly from 2025 because they are based only on the variable costs of operating a vehicle. Then there's the charitable rate, which stays at 14 cents per mile. That one is different because it is set by law, so it does not move the same way the other rates do. And a question I hear all the time is, does it matter what kind of car I drive? What if it's an electric vehicle or a hybrid? The answer from the IRS is clear. No, it does not matter. These rates apply across the board, whether you drive electric, hybrid, gasoline, or diesel. Okay, so knowing the rates is step one. But now comes the bigger part, the strategy. How are you actually going to claim your deduction? This is probably the most important decision you'll make when it comes to vehicle expenses for your business. So here's the big question. Which method should you use? Do you take the simple, all-in-one standard mileage rate? Or do you track every single dollar you spend and use the actual expenses method? The right answer depends on your business, your vehicle, and, let's be honest, how good you are at keeping records. Let's break down the trade-off. On one hand, you have the standard mileage rate. This is the simple path. You mainly need to track your business miles, the date of each trip, where you went, and the business purpose of the trip. Pretty straightforward. On the other hand, you have the actual expenses method. This is the detailed path. With this method, you deduct the actual costs of operating the vehicle: gas, oil, repairs, insurance, registration fees, depreciation, lease payments, if applicable, and other vehicle-related expenses. This method could give you a bigger deduction, but there is a big catch. You need detailed, accurate records for every single expense. And just to be very clear about what the standard mileage rate actually is, it is not just a gas allowance. Think of it as an all-in-one package. The IRS builds both fixed costs like insurance and depreciation and variable costs like fuel and maintenance into that one mileage rate. It is designed to simplify the whole process. But before you choose a method, you have to understand the rules of the road, because this is not something you can freely flip-flop on every year. The IRS has strict rules about switching between the standard mileage rate and actual expenses, and the rules are different depending on whether you own your vehicle or lease it. Let's start with owned vehicles. If you own your vehicle, your first year choice is very important. If you use the standard mileage rate in the first year the vehicle is available for business use, you keep your options open. You may be able to switch to the actual expenses method in a later year. But if you use the actual expenses method in the first year, you generally cannot switch back to the standard mileage rate for that same vehicle later. You are basically locked into the actual expenses method for that vehicle. Now, for leased vehicles, the rule is even stricter. If you lease a vehicle and choose the standard mileage rate, you must continue using the standard mileage rate for the entire lease period. That includes any renewals of the lease. So if you lease your car, your first choice matters a lot. Once you choose the standard mileage rate, you cannot switch to actual expenses for that leased vehicle during the lease period. Now let's talk about some of the fine print. You may have heard that most regular W-2 employees can no longer deduct unreimbursed employee travel expenses. And for the most part, that is true. But there are a few specific exceptions written into the law. For unreimbursed employee travel expenses, the exceptions include armed forces reservists, qualified performing artists, certain fee-basis state or local government officials, and employees with impairment-related work expenses. For moving expenses, the deduction is now mostly limited to members of the armed forces on active duty who move because of a military order and a permanent change of station. Certain members of the intelligence community may also qualify under special rules. And all of this brings us back to the most important point. The standard mileage rate is optional. You do not have to use it. You can choose to calculate the actual costs of using your vehicle instead. The only catch is simple. You need the records to prove it. So there you have it. You know the new 2026 IRS standard mileage rate. You know the difference between the standard mileage rate and the actual expenses method. And you know why your first-year choice can matter so much. At the end of the day, whether you choose the simplicity of the standard mileage rate or the potential bigger deduction from actual expenses, it all comes down to one thing: accurate, detailed, and provable records. So the real question is your record keeping ready for 2026?